comes on board, they will take it, but that will be incremental revenues. Now, how will they achieve it? One is scaling up verticals like BFSI, high tech, but they're also looking to grow other verticals like manufacturing, resources, healthcare. But I think at the core of everything, what the management spend time talking about is AI. It's AI in everything for AI and AI for everyone. They're also looking to mine the Fortune 500 clients better. But apart from giving that $10 billion revenue milestone, the company said that they need to do a double-digit revenue growth to achieve their EBIT margin aspiration of 17 to 18%. Just in the near term, they did indicate the discretionary spend has not returned, but now with the US elections out of the way, many clients will finalize their budgets in the coming months. But for now, discretionary spending is not back.
All right. It's not back. Reema, thank you very much for that. We've got the market open coming up in the next couple of seconds. There you go. What do we have? First rates. The Nifty is starting absolutely flat, 24,181. The Nifty Bank is down about 0.13%. Sensex is flat. Mid-cap index is starting slightly higher. So 55,985 on the mid-cap index. There's a little bit of green. By the way, yesterday the mid-cap index sold off in the last 60 minutes of trade. Completely sold off, and but the small cap index had about 0.8% gains by 3:30. What do we have in the Nifty heat map? Just an overall sort of quick look. 25 down in the Nifty, and you got some 30 names which are down, 20 names which are starting in the green. So that is the Nifty stock heat map coming up on your screen. Let's get it down to individual names. Surabhi.
Okay, we're looking at very flat to muted cues right now at the index level. Talk about the winners, and this is the stock that we've been flagging off right from the morning. M&M is electrified, should we say, 2% higher. That makes it the best Nifty winner for the time being. Then there's Coal India, NTPC, BPCL, a couple of PSUs are doing well this morning, even BEL for that matter. There's a bit of green out there. Adani Enterprises about 0.5% higher, but then that's about it. It's very quiet with the bigger stocks like HDFC Bank, Kotak Mahindra Bank. Shriram Finance is cooling off after 2 spectacular days, 8% up in 2 days. And finally, there's some red coming in. Speaking of red, Bharti Airtel is cooling off after yesterday's good showing, 1% down. Cipla, Tata Consumer, Britannia, Lever, so there's a fair amount, Nestle as well, so there's a fair amount of FMCG on the way down this morning. Throw in a Titan as well. So basically, consumers in a soft spot. Reliance, I saw open out on the negative side of the screen. Yeah, it's still down about 0.3%. So pretty flat, fairly muted. And that's what we have, at least for the time being. Even the mid-cap index down about 0.25% for now.
Well, that's right. A few stocks, though, deserve special mention. You have Ola Electric. That's higher in today's trading session. They have launched a new range of scooters as well as PowerPod. So, both that stock, in fact, is moving higher on decent volume. So that comes up for you in the screen. Fed-backed financial services, the volumes are quite high actually, and the stock is up more than 10%. In comparison to what we normally see, volumes are very, very high for just a couple of minutes of trade. So Fed-backed financial services should come up for you. Up 18% as we speak. We'll just check in terms of news flow on that one. Talbros, they won a big order, 475 crores in a JV. So the street likes that. That one as well is moving higher. Sagility, that's a newly listed company. That's another big volume mover. That's up close to around 8 to 9%. Massive volumes on that particular name as well. Swiggy, well, those who got allotted in that IPO, and there were quite a few who did because it wasn't oversubscribed to a large deal. Well, the stock is headed towards 500 rupees now. So good move is what we're seeing. Volumes picking up on that one as well. On the flip side, ZF Commercial, because of that block trade that's just taken place, 5% equity takes place. That one's down close to around 14%. Interesting to see what happens from here. Prestige Estates is another one that's losing out big time. That's down close to around 4.5%. Volume's fairly decent as well. So Prestige Estates comes up for you. And Adani Green is another one that's reacting in the red. As we speak, the markets are as flat as can be. That's the headline index. The mid-cap index is well flattish, and the Nifty Bank. But two stocks that deserve special mention. Fed-backed financial services now up 20%. Sagility up close to around 10%.
Nigel, Sagility was up 10% yesterday as well.
Yeah.
Ended higher, circuit up. And by the way, it's one of those names which came to the market recently. I think it's about not even 10 days old, maybe 10 days old. 12th of November is when it listed. And it had a pretty muted listing, flattish. It's a company which is in the technology space, works with insurance companies and customers of insurers in hospitals and insurers essentially in the US. That's the space it works in. It was a completely private equity-owned play. And the private equity in question had sold some of the stake, pure OFS, I think it was, in the IPO. But 2 days, 20% now, with today's 10% pop. Triveni Turbine is another one. Triveni Turbine, by the way, is the #1 volume-led gainer. I'm not sure if there's news flow, but it was a big mover yesterday as well, which essentially means that in 3 sessions, actually 2 days and 5 minutes, that is the third day is today, it's moved up from 680 levels to 880. There's a 200 rupee move in 2 sessions flat. Let's see if these gains hold this morning. And of course, Siemens, Vivek was telling us, I think you guys mentioned that as well. Ola, I think we mentioned that one, 4%. Aster DM is up 3.5%. It's got large volumes, Aster DM, and it was a bit of a mover yesterday as well. TTML came up, it was a very large mover yesterday, TTML, on big volumes, and it is a big volume-led mover today as well. Swiggy you mentioned, Sagility we highlighted, Cochin Shipyard. Keep an eye out on these, defense names as well. So yesterday it was Garden Reach. On the shipbuilder side, Garden Reach was up about 7-8%. Cochin is up about 4% this morning. KEI is up 3.5%. There is Genesis, which is another company. I think there's an initiation report from Elara on Genesis, and that is up about 4%. But it's run up in the last 3 days from 750 to 900. And today is the third day of that move that we have on our hands. Fed FINA, Nigel mentioned earlier, with that 19.5% pop. There is 361, the wealth manager, which is up 5%, 1147 on 361. So, yeah, I mean, things are just opening up, and there's a fair bit of activity, which we are looking at. Yesterday, by close, the biggest volume-led loser was BSE, and it's got tremendous volumes this morning as well. It's the second largest volume-led loser. It's only down 2.5%. Yesterday was down 5%. It's down about 2.5%. But look at volumes right at the word go within the first 2 minutes. Surabhi?
Remember Talbros we were just discussing a while back. So that's holding on to an 8% gain at this point in time on the back of those auto wins. Cochin Shipyard, some more defense names are also up and about. By the way, if you're wondering why Fusion Microfinance maybe is not reacting, because typically, as the market wisdom says, rating agencies are the last to react. The stock's already, fallen some 70-80% this year. So, 2 of them have, I think one has put it on a ratings watch with negative implications. One has cut ratings. But anyway, it's already in the price, perhaps.
The police in Hindi movies.
There se aate hain.
Without, of course, a specific comment on anyone per se. But, so yeah, absolutely. And we'll see what comes of it. Markets actually, again, like a traffic light, right? Blinking red and green, nothing on it. 5-point change with about 2 or 3 minutes of action behind us now.
Just one more stock, Tilak Nagar Industries, just take a look at that stock the last few days. It's moved, I think, from around 340 rupees all the way to around 400 rupees, and volumes as well fairly large. So the street is sensing something. I remember we had a chat with the management as well. We were asking them whether they're doing some inorganic growth. They were sounding fairly confident on business as well as on margins. But that one has been one of the big movers, up close to 3%, building onto gains that we've seen in the last few sessions.
By the way, Nigel, it reminded me that Imperial Blue deal, I'm told, is almost done, but it's not Tilak Nagar.
Oh,
that's what I'm told. But we'll see.
Interesting.
What comes off it. Sanjeev Prasad is with us, Managing Director and Co-Head at Kotak Institutional Equities. Sanjeev, good morning. Great to have you with us here. Thank you for your time. We're chatting after a while. I'll get to specifics in terms of earnings estimates, etc. But the big question for a lot of the local audience, every day, FIs have been selling and selling and selling. 2 months now. Yesterday, they were small buyers. What is your sense, Sanjeev? Any thoughts at all? Are we coming to the close of this episode?
No, it's hard to say, to be honest with you. But if you look at the FI flows, I think when most people look at the FI number, it's actually a very misleading number. So it's a negative $2.5 billion, calendar year to date. But if you look at the breakup of that between primary, secondary, active, passive, it looks like the active secondary flows have been negative for a while now. So just to give some numbers, $2.5 billion negative calendar year to date. Out of that, you have about $12 billion of primary inflows, by the way. So if you strip that aside, the secondary numbers are actually much more negative. And you also had about $13 billion of passive inflows. So if you take that out, you probably have something like $25 billion of active secondary selling in the current year compared to the headline number of $2.5 billion. So that would suggest to me that many of the active fund managers have been negative for a while. And there are enough reasons for that. Valuations have been on the higher side for a while now. And you have seen the earning numbers have not been anything great. People, I guess, have found some opportunity in China in September, October. And I guess right now people are seeing a lot many opportunities in the US, I guess. So as far as emerging market active fund managers are concerned, the big challenge for them is absolutely no inflows. Because the EMs as an asset class haven't given much of returns for the last 10 years now. And the US market doing so well, strong US market, strong US dollar. And obviously the asset allocators are not inclined to look at EMs as of now. So I suppose this trend could very well continue unless and until the markets, settle at a level where valuations become a lot more attractive for active secondary market investors.
Well, according to you, and you're a completely numbers, fundamental focused analyst, Sanjeev. Where is the cushion? At what level will it interest investors?
You have to look at this market more on a stock by stock basis or cap by cap basis. So if you look at the large cap names, Nifty itself may not look very expensive. It's about roughly 21 times, 1 year forward kind of a number. So it looks okay, but keep in mind the fact two things. First of all, we are looking at pretty strong earning numbers for FY 2026 as of now, 16.5%. So whether that will come or not come, that's a big question mark given the cyclical slowdown that we have seen at least in the first half of this financial year. And second thing is, there are some structural challenges which have started to emerge in terms of job creation and so on and so forth. So you could possibly see more of a earning downgrade as we go forward. Third thing is when you look at the Nifty valuations, again, it's a very misleading number because about 50% of the net profits of the index comes from lower P sectors. 27% comes from banks, about 5% from metals, 19% from oil and gas, which are, trading at between 13 to 15 P. If you look at the rest of the Nifty, valuations are very, very expensive. Beyond, I would say banks to a large extent, everything else is expensive, both on an absolute basis versus history, versus all the challenges that are coming up, versus earnings growth, whichever way you cut it, valuations across the board are, I would say, full to frothy in some cases also. So that's the challenge. You still haven't come to a level where valuations are starting to look attractive. So again, two more points I will highlight. If you look at the stock correction, they have either happened in sectors where you have seen massive earnings downgrades, right? Which hasn't really helped the case of the valuation, because valuations have stayed on the higher side given the fact that earnings are cut. And the second area where you have seen earnings down, where you have seen a massive price correction in the entire pack of what I call as narrative stocks. And many of them corrected between 20 to even 50% in some cases. I think they need to be significantly lower. The real value should be about 20 to 50% of the current market price, even after correcting so much. So the long way to go in many of these, mid-cap, small-cap, narrative kind of stocks. So that's the one challenge. The headline valuation will look okay, but if you look beneath the bonnet, there are a lot of challenges when it comes to valuations. At max, you would say, at best, we can say you have fair valuation for banks. In the case of consumption, outsourcing, pharmaceutical, IT sectors, etc., and pretty frothy for the rest of the market, I would say.
Okay. Frothy in large parts of the market, maybe okay for banks and the narrative stocks. Great to have you, Sanjeev, on the show as always. So let's talk about the narrative stocks. And if I get the hint correctly, I think this is exactly the space we were discussing with an analyst earlier. The PSU space, CapEx, right, sort of long gestation themes. If you could just elaborate on your thoughts on the so-called narrative stocks, what specific pockets are you referring to? Because the thing is, there's still a lot of ordering activity. I mean, look at the Hitachi order yesterday, or, Power Grid is getting orders. Railways are still dishing out some orders, as with defense. But again, I think the question is how much is still left on the table? So if you could just elaborate that point, narrative stocks still not good enough?
I think you have to look at in the context of, the market cap of this companies versus, the profit numbers and potential profit numbers, assuming all the good news. I will give you a couple of examples. I mean, you talked about Kotak Shipyard in the morning. The stock had done well in the last 3 days. I mean, this is a company which is about almost 40,000 crores market cap now. The net worth of the company is only 50 billion rupees, 5,000 crores. So it's trading at 8 times book. Last year's profit was about roughly 800 crores. Yeah. So it's trading at 50 times P. What sense does it make, to be honest with you? You have companies like Hindustan Copper, 27,000 crores market cap, 3 billion rupees of profit last year, roughly 25 billion rupees of net worth. It's trading at more than 12 times net worth. You have ITI, loss-making company, trading at 27,000 crores market cap. IRFC, 2 lakh crore market cap, more than 4 times price to book for a finance company, which is, I don't even know, it's more of an intermediary finance company. That's it, right? Wholesale borrower, wholesale lender. So there are so many such examples, BHEL. I can go on and on. There are enough number of examples which I could narrate. I mean, I just struggle with the valuation of many of these names, to be honest with you.
I completely take that point and I understand the pain, Sanjeev. But I guess the thing is, forget FPIs, but when there's like 40,000 crores of liquidity hitting the equity markets just from domestic, mutual funds. I'm not even talking about other institutions and insurers and EPFO and so on and so forth. But if there's that kind of money hitting, then I don't know, how do you wrap your head around the valuation argument? And I think the issue with a lot of investors is going to be how much cash can you really hold in portfolios, even funds, even mutual funds. Many of them are still sitting at 8-9% cash levels. Relatively speaking, aside from banks, would you look at buying anything in the market now?
You say understand the pain. I don't know if, I'm actually fine. I don't have any individual stocks in it. You'll find out the pain for many of the investors who are in the stocks, sooner or later, I would say, when the stocks eventually they will correct to 20 to 50% of the current, current market cap. So there is going to be a lot more pain in the market, I don't have much doubt about that, because none of these, valuation are really stable. Coming to flows, see, this flow is a reflection of expectation ultimately, right? Obviously in the market, somebody buys, somebody sells. There is no money in a secondary market at any given point in time. Why is so much money coming? Because investors have decided that they can, and they will always make large amounts of return in the market, which has been the case in point. Over the last 3.5 years, returns have been very good. But if you look at the last 6 months, returns have become pretty modest. 3 months, it's negative. And if things continue like this, and as the trailing returns start declining, you would assume that the flows will also start to come off. Flows is just a reflection of the expectation, and expectation based on whatever people have seen in the past. As of now, people are still looking at the rear view mirror, assuming you have a lot of money to make in the market and pouring in money. But honestly, there's no valuation support for most of the markets as we're discussing. Yeah, the stock prices can go up, but ultimately one has to look at value versus price equation at any point in time. And in most cases, there's a very large disconnect between price and value. In terms of the price is significantly higher than the fair value of the companies.
Yeah, you've used BHEL from the power space as an example. You've used that as an example to highlight some of the difference between value and price. But any thoughts on the space? By the way, we have the management of, it reminds me, Hitachi Energy. The management is coming up with us in just a bit. I mean, clear leader in their space. Stock's done very well. I don't know if you have any thoughts at all, Sanjeev.
I'm sure there will be pockets of, value. Value in the sense, the news flow would be positive. But whether it is sufficient to justify the current market cap, that's the call investors have to take. I mean, you want to talk about bail, let's assume 100% of all the orders which the government of India wants, 80 gigawatt, will be given to bail over the next 8-9 years, which is the target, right? And you do a simple math, you take, let's say, 60 billion rupees per gigawatt, multiplied by 80 gigawatt, that comes to 4.8 trillion rupees. You take a 5% PAT margin, you come to 24,000 crores. As the total potential profit pool for the entire industry over the next 8 years. The market cap for BHEL is 80,000 crores. I mean, you reconcile the math over here. Even if you take 10% PAT margin, it will come to 48,000 crores. So that is what I'm talking. And even not even discounting the cash flows, by the way. You are in this math, you're assuming all the profit comes today. If we discount 48,000 crores over 8-9 period, it's obviously going to be a much lower number. But that is our challenge over here. Anybody who's numbers focused, bottom up focused, it is very hard to reconcile the fundamentals with the kind of market cap people are giving to stories at this point in time.
I don't know, and that's a very nice illustration once again. I mean, I think, we need to kind of revisit that sometimes because a lot of, as you've, I think, written in your reports as well, a fair bit of narrative, etc., which, of course, has supported many of these sector stocks, etc. Sanjeev, thank you very much for joining us. Great speaking with you, and it's a pleasure. And look forward to our next chat. But as promised, Nigel, we have the Hitachi Energy management with us.
Well, let's get straight to it. Hitachi Energy, that's a stock on our radar after BHEL and the company's consortium won an order from Power Grid for a renewable energy transmission project between Gujarat and Maharashtra. To talk more on this HVDC order win, as well as the outlook on business, we're joined by Mr. Venu, the MD and CEO at Hitachi Energy India, who joins us. Hi, Mr. Venu. Good morning. I recall when I visited your facility in Karnataka, you said, Nigel, have patience. Things are in the works and hopefully things will start fructifying. And you also told me this, that earlier one HVDC order used to come every 5 years. You expect that frequency to go up, and so it is. We have a big order win. Now, give us a few details, and we're trying to get a couple of numbers out of you. Most analysts estimate the total project cost to be around 25,000 crores odd. And out of that, the equipment cost could be around 40 to 50%. So roughly this order size could be around 10 to 12,000 crores odd. Ballpark, these numbers should be correct?
Thank you, Nigel, and very good morning, and thank you for having me in your show. And as you rightly said, we have been discussing this, and we not only were discussing this as a company, we have been taking a lot of actions over a period of time. Actions in terms of in terms of adding additional capacity or creating a new factories. In the last 2 years, a combination of brownfield and greenfield, we have added 5 factories, and that's all basically in anticipation of the demand tailwinds arising out of this energy transition, and especially the HVDC, which is a very, very critical technology for bulk transmission of the renewable, bulk integration of the renewable things in that. So by virtue of this technology, and it's become a seamless transfer of renewable generated from one concentrated center to all the way bringing it to the load center over a distance of 200 kilometers. And
yes.
I'm coming back. And normally, these are we are not given this order number in the note which we have sent yesterday or day before yesterday. So what I said, this is a very substantial order for us, and it gives a 4 to 5 year period where we're going to execute this particular project. And most of this is manufactured locally in our factories in India.
Got it. All right. We know the technical, advantage that you have, and y'all are most equipped. But, let's give a 10% deviation on both sides. 25,000 crores should be a fair number to work with. 10% deviation on both sides. Is that fair? And equipment cost typically for an order like this will be 40 to 50%. Ballpark, these numbers are correct?
The 25,000 crores, what you're talking about an SPV, that does include, what I understand, is also transmission lines, which we don't do the transmission line. But our equipment will be anywhere, depending upon the size, scale, etc., anywhere between 50-60% of the total.
So transmission is not, you're not going to be part of it. So how much would it typically be in a project like this, transmission as a percentage of the total order size?
Typically, our size will be in the range of 50-60% of the total SPV project.
More than 50,
depending upon what the size, etc.
So 25,000 crores you said is including the part of it which you all are not into. So X of that, how much could it be? Will it be closer to around 20,000 crores?
What I'm saying is that and the total project, if you take, our portion will be 50-60% or 70%, depending upon the size, etc.
But what is the total size, sir? Is it 20,000? Is it 25,000 crores? We got it's 50 to 70%. It could be roughly. But what is it? 20 to 25,000 crores? Could we work with that number?
Nigel, as in please respect, we are not given that because there is an ongoing some other things are there. So
just give us
what I can tell you is
one
that
more
it's
detail.
quite a substantial, and it gives a revenue visibility of at least 3 to 4 years.
Give us one more detail. You're in a consortium with BHEL. I'm looking at some back of the envelope calculations, and they're saying out of the total equipment cost, Hitachi could be around 75%, BHEL could be around 25%. This should be the rough ratio, 70-30 approximately?
In the joint venture, yes, you are right. We are in the 70% and BHEL is in 30%.
Okay, so Nigel has tried, and I think you've given us as much as you can, which is around 70 to 75%. We'll have to work with the numbers and wait for it to come through. So let's talk about the order book growth. As the numbers that I have, I think as of the end of the second quarter, your total order backlog was around 8,900 crores, right? And now this big ticket order has come through.
Right.
So, and then you're not giving us the exact quantum, but will there be more HVDC orders of this kind? And you've been very bullish on data centers, on transportation, on the renewable sector. Give us more color on the order book. How is it likely to be by the end of FY25?
Right.
And what will the breakup be? Because you have also said that your margins eventually should go to double digits. How is that going to happen? Which is the segment in the order book that will be fetching you maximum margins? And when do you touch double-digit margins?
Right. So absolutely, as you rightly said, let me touch on the HVDC. We have been saying that HVDC previously used to be one HVDC project for every 5 to 6 years in India. But today the need of the hour is to have one HVDC project per year, or as we going forward, it may be 2 HVDC projects per every 2 years. Okay, that's a demand is going to be there in that. But based on our publicly available information, we see at least 3 more HVDC projects are coming under bidding, or some of them are in the bidding process, and where we are also looking actively those 3 projects as well. And in addition to that, we have been also maintaining very consistently saying that we have a very clear strategy on the growth segment, high growth segment. Data center is one among them, and then renewable, the transmission, and the industries. And in addition to that, we also talked about the 2 other levers, that is our exports. We brought exports on a consistent basis, 25% of our total order values, and also the services, because we have been present 75 years in this country, and we have created a huge, pipeline of our install base, and we would like to leverage that install base to offer our digital and services to our customers. And the services also high focus on that. We are taking a lot of actions in driving the service business for Hitachi.
So the margins, so how do you get to double-digit margins? Yeah, which is what you've been promising.
Margins is a combination of growing ahead in the market and also the exports. We are consistently driving the exports. And the third one is the service. Definitely will give a much higher margin in the service portfolio. In that, all these 3 combination of that, and in addition to our various other initiatives of whether it is manufacturing efficiencies, bringing productivity, all those things would help us to get to double-digit margins.
Okay. So good morning, Prashant here.
Good morning.
On the renewable energy front, right? Building out the transmission and distribution to get the power out of these so-called renewable energy zones. Are there is work going on pretty smoothly? Is it challenging? If you can give us some color.
Yeah, I think it's a combination of both, Prashant. I would say, India as a country has set a target of 500 gigawatt by 2030, right? So to reach that level, we need to do anywhere between 50-60 gigawatt per year. We need to add. Right now, we are adding around 20 gigawatt per year in that. So there is definitely need to catch up in the next 2-3 years to get into that 500 gigawatt of target in that. So yes, there are some challenges in between. But I would say that, this is the technology is pretty much, standardized, and you are able to, once we have the land, etc., the developers are able to complete the projects well in time. And also at the same time, the government has announced as part of the National Electricity Plan, launched, transmission plans, and that gives a huge visibility. By the time your generation comes, your transmission is also under construction or under completion stage. And that's where the HVDC will play a major role in that integrating those renewables into the grid.
So does HVDC fetch you better margins than the other segments? Just trying to understand. Or is it going to get very competitive? You're saying there are 2-3 more big orders, HVDC orders, that will come up this year. But how intense is the competition? How are the margins?
No, competition is there in every sector, every segment of that. As I said, we have been investing in this, localizing the margin issue is how much you localize it, how much you produce it, how much engineering it locally is that. Today, we are able to do end-to-end, localizing the HVDC technology in that. So we have a converter transformer, we have valves, we have engineering, and all those things would help us in a better competitive. We are able to compete in this market.
Okay, all right, Mr. Venu, I need to push you a little bit more. The Leh-Ladakh order, we had briefly spoken about it in the past as well. By when should we hear the outcome of that?
So our customer has placed the order for the study spot. So we did complete our study and we have submitted our report to our customers. And based on that, we expect the customer to, start floating the tenders in the next maximum in 1 to 2 quarters.
1 to 2 quarters, and the outcome would be
floating the tender. So after that, we have to tender it, and then we have to win. All those things are there.
So it could be roughly in the next 4 quarters, we should get an outcome, because in the next 2 quarters, they'll float the tender, and maybe another quarter to get the outcome, right?
Right, absolutely.
So, and that could be the other big HVDC order that we're looking at. Got it.
Yeah.
Just a quick point, on margins, exports as well as services. They are the margin drivers as well, relatively better margins. And I think exports you briefly mentioned are at around 25% of the mix. Is that correct?
Right.
And services, you were guiding that it goes to high teens. Has that happened? If you could just update us on both these two numbers, exports as well as services. What is it? Where is it headed?
Okay. On the services, we are in the high single digit, and which is the last quarter we moved it to double digit, and over a period of time we believe that it will be in the double digit range in that. And the exports, we started when we started in the company, we were on the 15%, and today we brought it 25% in sustainable. I think going forward, we will end up around close to 30% range. So 30% exports and 12 to 15% is the services, and that would really help us to push our margins.
Okay, all right, Mr. Venu, thanks a lot for joining in. The stock price had come off a little bit from the top after seeing a one-way move in the last 12 to around 15 months or so. But you're sounding fairly optimistic about business prospects. And I think from a nation's perspective, if we're going to get a higher number of HVDC orders rather than waiting for 5 years, that'll be good news as we progress. Thanks a lot for joining in.
Thank you for having me here.
For the time being, we'll slip in a short break. On the other side, Mr. Vimal Kejriwal of KEC International is waiting for us. We'll get chatting on their recent order wins and business outlook. Host.
Welcome back. It seems power and capital goods has become a bit of a theme for the show. You just heard from Hitachi, and that big HVDC order is the talk of town, really. Our next company in focus is KEC International, also related to the T&D space in India and overseas. Now, KEC yesterday announced a bunch of order wins. The total value of these orders is coming up to about 1,100 crore rupees. So what lies ahead for the second half? Is the company on track to meeting its guidance, order inflow guidance of 25,000 crores? Well, let's get chatting with Mr. Vimal Kejriwal, MD and CEO at KEC International. Mr. Kejriwal, it's only been power talk, I'll tell you, for the last 1 hour on the show. Because, we had an analyst earlier on who was telling us that while we're looking at the bigger MNC players like a Hitachi or like a Siemens and these big orders, I mean, a lot of these orders obviously require, a fair amount of other ancillary, work as well. But even when you're talking data centers, right? I mean, power, if you're talking power, you need T&D infrastructure. So you tell us, how optimistic are you on the second half? I remember in our last conversation, you were saying the second half will be much better. Margins will really pick up by the fourth quarter. So what are the newer orders on the horizon along with this latest 1,100 crore win?
So, Surbi, good morning. And I think you are almost on dot on all the items. I think I've been in this industry now for 22 years, and I don't think we have ever seen such a flow of orders coming in and also a flow of tender pipeline. And I was hearing Venu, my good friend, talking about what's happening on HVDC. And if 3 more HVDCs are coming, that itself will add a lot of pipeline to transmission also. It's very clear that the sector is buzzing with the thrust of the government on the renewables now from 500 gigawatt. They have said they want to make it 600 by 2032, which will add, further requirement of large transmission lines.
Right.
So, sir, okay, so let me actually take off from there. And since you mentioned HVDC, and Mr. Venu just told us that 2 more big HVDC tenders that will come up this year, the frequency of these large orders is increasing now. So, what does it mean for a company like KEC? Does the guidance that you've given, 25,000 crores of orders this year, does it factor in this heightened activity on the HVDC side?
It does factor in some orders from the HVDC sector, and I was hearing how you were filling Venu and trying to get some more information from him. But I think on transmission, since he did not try answer, so let me give you one answer, is that transmission would be around 20% of the capital amount of an HVDC. That's the number we have generally been looked at. And I think that's part of it has been factored into our guidance because we do expect that beyond the current one, at least 1 more HVDC will get ordered within this financial year. So there will be 2 HVDCs ordered in this year.
Right. So it'll be 2 total, 1 more left. Mr. Kejriwal, good morning. Just talking about the railway business for a quick bit as well. Last time you were on, you were saying that there were 7 to 8 Kavach tenders which had been put out, I think, but that was in September, October. This morning, there was I think 1 or 2 orders which came through as intimation to exchanges. I think CG Power got an order, Kavach order. Anything latest on that?
So as far as I understand, what has happened is the orders have been broken up into 2 parts. One is the Kavach on the locomotives and second is on the EPC. So we had participated in the EPC. I think those have not yet been awarded. But some of the loco orders, I think you remember there was a figure of 10,000 locos being fitted by Kavach. So I think a part of that has been awarded in the last couple of days or maybe yesterday. So that is what has been probably announced. But I think we expect that the others will also get announced in the next week or 10 days.
Right. And you also told us that you've consciously reduced your railway work a little bit, right? I mean, I actually rather shifted it to Kavach and signaling systems, etc. Do you expect do you expect a more pronounced change in strategy, especially after the Maharashtra elections now? Any implications thereof? Because it's a very strong mandate. And on the railway side, will things change?
I do hope so, because we have been looking at saying how do they invest more in the infrastructure. Railways have been investing right now more on the, I'll say, passenger amenities and passenger trains and all that. Now we are seeing a lot more tenders coming out. And as far as our change of strategy is happening, what we are trying to do is we are trying to, I'll say, slow down on tenders which involve working on live railway lines. But that has been the bane of the sector, where you are not getting, what we call blockages to work on railway live lines. So we are now shifting to, like the one which we announced is for electrification of a metro, which is a new metro. So there's no ROW or anything. The day the viaduct is constructed, you can go and do your line. So there's definitely a change in our strategy. But we are clearly seeing a lot more orders coming out for new railway lines and doubling, etc.
Finally, sir, what would your total exposure be to the state, to Maharashtra, across all lines of businesses? And with this kind of a mandate at the state level, are you expecting anything new? Would there be any ask? Are there any major projects that you would expect to see more action on now that the elections are behind us?
So unfortunately, our exposure is virtually zero to the state of Maharashtra. Okay. We have a lot of private sector projects in Mumbai and all, but we have consciously been away from almost all the state businesses. Let me be very honest with you. So most of our clients are at the central level. State is very few states we operate in. Maharashtra is not one of them right now. Now with a different mandate and a much more stability, we will start looking at what we need to do. Let me tell you one more thing, that there have been very few, I'll say, P&D projects coming in at the state level in Maharashtra. But we are finishing 4 projects in Maharashtra right now. We are bringing power to Mumbai. but almost all, I think all 4 are for the private sector. So Maharashtra, I think we'll see Maharashtra will probably see a lot more transmission orders coming in now in the state, because they need to strengthen the grid, especially for the data centers and.
Okay, all right. So you've been staying away from a lot of state government work, but maybe you'll make a debut in Maharashtra now. Got that? And we'll look out for more signs and signals on it. Thank you very much for joining in, Mr. Kejriwal.
Thank you.
And look forward to another call soon. That is KEC International. Let's do a quick stock check of the market before we move on to the next guest. The market's managed to bounce back into positive territory. That's good news. So there is buying on dips that's happening, about 30 points up now on the index.
Just 2 stocks. Swiggy headed to 500 rupees. Massive move, big volumes is what we're seeing. And Zomato as well, since it's making its way into Sensex, the street will start factoring in that it could possibly make its way into the Nifty as well. Yeah. Both those 2 big volumes is what we are seeing on that. And just one more name, NIT. The last few days, the stock has seen a big run. In this month, it's up more than 40%. You know, the stock today as well on very high volumes is at around 225 rupees.
I'm just looking at the UBS price target on Swiggy. It was actually northwards of 500. That was one call that was really noted by the market. Yeah, 515 is the UBS call. They just started coverage on the stock, and it's quickly, rushing towards that target now. Anyway, let's move on. From the power space, we're putting the spotlight now on banking. Let's first listen in to what the RBI governor had to say on the expectation of this draft circular on the ECL framework. There has been a wide consultation on this. RBI Governor Shaktikanta Das earlier this month on the sidelines of the CNBC-TV18 Global Leadership Summit said that the introduction of the ECL framework will mark the transformation of how assets get classified. Listen in.
With regard to the ECL framework, that is expected credit loss framework, even after issuing a discussion paper and receiving stakeholder comments, which we got examined by an external working group, we now propose to issue a draft circular for implementation of ECL. So the draft will be followed by issuance of a final circular. Again, we will get comments, and we are adopting this very careful approach because it, the introduction of the ECL framework marks a major transformation in the way, the assets, the stressed assets or the buildup of stress or the way the assets get classified.
Okay, so this is another major move, and that's coming. And it's a move that's coming because anyway, the accounting standards are changing. And as we move to the next standard, ECL is going to be a requirement. We have with us Mr. Sunil Mehta, Chief Executive at the Indian Banks Association. Mr. Mehta, thank you very much for joining in. Great to have you, sir. Now, this discussion has been on for many months, right? The first concept on ECL was floated, I think, much earlier this year. And the whole concept deals with the fact that you need to start recognizing stress before the delinquencies happen, before the delays in payments start happening. So now at an industry body level, what's the thought? Is the Indian banking sector ready for it? And what could be the immediate sort of increase in, say, credit costs, provisioning? What will the numbers look like once this is rolled out?
So good morning, and let me first tell you that I have already demitted the office of CIBA. So I'm participating in this process in my individual capacity. That is, it's not it's my individual views. Another thing, we have been in discussion with the RBI, and we have been discussion within the industry about the expected credit loss and its impact on the industry. And what we understand from the entire ecosystem is that this ecosystem is gearing it for it. And this will make the provisioning requirement more realistic, because this is based on the expected credit loss, will be more realistic based on the empirical data and the time series data which the banking system has on the losses on a particular type of assets. So with cases, the thumb rule approach will go away, and the ECL approach will step in, and that will really improve the balance sheet transparency of the banking system. So anyway, the move in long run will be strengthening the banking system, and the system is gearing up to adopt it.
Sir, again, the question is, what would it mean? If we look at some of the views, ICRA put out a note on this earlier, and ICRA said that this whole transitioning to Ind AS the impact on core capital for banks could be as much as 300 to 400 basis point, including the ECL transition itself. So it's overall Ind AS plus ECL. Could it be that high? What could be the impact on capital requirements? Some more color on this.
So as regards capital requirement, if you analyze the data of the banking system, I think most of the banks already have, especially the major system already have capital adequacy 200 basis point more than what is required prescribed under the norms. So that much cushion is already available. As regards the transition, I think Governor has also said it very clearly that this is a phase in which it will be put up on the discussion papers, views will be invited from the stakeholders, and this will be implemented in the phases. So I think the system is already geared up, banking system is already well capitalized, and this is the right time for transition to LCR system. So because ultimately banks are in a position to withhold their existing capital positions, support the ECL transition, and make the balance sheet more robust in the times to come.
Okay. So just give us a second. That's NTPC Green. And NTPC Green starts its journey on the green side of the screen. 113 to kick it off. It's a large issue, 10,000 crores. And we have the entire top management team there.
To the management, investors, stakeholders of NTPC Green Energy Limited on the official listing.
Okay. It's actually gaining some ground now. 7% is supposed to be an absolutely flat listing. But it seems to be doing well. And we had, of course, our colleague Vivek earlier telling us that right now they're only at about 3.2, 3.3 gigawatts of capacity. Supposed to go up to 60 gigawatts of installed renewable capacity over the next six odd years, 7 years.
Brings back memories to me, Surabhi. NTPC itself, NTPC Limited, listed in 2004.
You remember it?
Remember it? I applied in the IPO.
Okay. Then you remember it for sure, yeah.
So I think 2004, and that one came to the market at about 70 rupees. I'm just looking at the price. I don't remember the price. But at whatever 70 rupees or so. And of course, that's had a fantastic journey. And now the second one, NTPC Green. Coming in 2000, back into 2024, 6.5% higher. So it's a pretty good one as far as, and I think it's now trading at what 5 times FY25 book value, approximately 4.5-5 times FY25 book value, which isn't cheap. But it's a marquee name, largest player, a lot of government support. So it's got a lot of tailwinds going for it as well. So that's the latest one. And I think that should be the last big IPO for the year, or are there any other ones? I'm not sure.
Now that Swiggy's done, NTPC is done.
At least for the year, maybe.
I think, maybe we get into a bit of the December mood from here onwards. Had some marquee names come to the market this year. Hyundai, it's been really the year of IPOs as well. Anyway, getting back to that conversation on banking with Mr. Mehta. So, Mr. Mehta, you're saying that, ECL, this is a good time. And given where we are in the credit cycle, perhaps a good time to make this transition. Just to complete this point, and then we'll ask you about the new LCR rules as well. From an operational standpoint, what changes for a bank once you move to ECL? Because you don't wait for a delay in payment. You have to start recognizing that stress earlier. So, what changes operationally on the ground, if at all?
So basically, the historical data which banks have about each segment of their credit book, and they have a historical data that what is the expected credit loss in each case, and depending upon the various parameters for every individual asset, the expected credit loss can be identified in advance. And because multiplication probability factor is already available in the banking system, and that will help them to provide it for the way RBI prescribes for provisioning norms even for standard assets. Same way, the provisioning norm for the existing standard assets who are not fallen into NPA, the bankers will have to start making slight provisions, keeping on their historical data in mind. That will help them in strengthening their balance sheet in times to come. And this transition will require a good set of data with the banking system till they don't have their own set of banks' experience data. they will have to rely on the industry averages which are available, and that will convert into the probable capital or the provisioning requirement for individual segment of the credit. This will facilitate two more things. One thing, because the provisioning will be on the expected credit loss, bankers will definitely become extra quality conscious, and quality consciousness will definitely help them in building a better loan book.
Okay, all right. Running out of time, sir. So we'll leave it on that note for today. Thank you very much for joining in and giving us some perspective on the rollout of the expected credit loss framework, which is going to take place pretty soon. Well, with that, let's actually go back to the market. We've got a very, very flat screen again. We had the little bit of a 20-30 point gain, but that's now fizzled away again. Back to the flat line. Mitesh is with us. Mitesh, slightly choppy, no clear directional call. It's all about individual stocks today. What trades now?
So be two things. One, I think, it's been choppy. Yesterday was also a consolidative day. But if you look at the, intraday lows for Monday, Tuesday, and Wednesday. Monday was, I think, 24,135. Then yesterday, Tuesday was 24,125. Today is 24,145. So broadly, this 24,150, 120 zone is holding on. Maybe, if this consolidation, if it can break, if today by late afternoon today or tomorrow morning, then I think on the upside, the Nifty could retest 24,350, and beyond that, we could see further upside. So to me, while it's been slightly choppy, I think the overall bias in the short term, looking at the indicators on the hourly and 2 hourly charts, still is on the positive side. So I would, suggest that traders can build longs around 24,150 zones with a 70-80 point kind of a stop for a target of 24,350.
Okay, all right. Your any new ideas, Mitesh?
Yes, Prashant, I have a buy on Power Grid with a stop at about 335 for targets of 350. And IRCTC is also a buy with a stop at about 810 for targets of 855.
Okay, all right, got it. Thank you very much for joining us, Mitesh. Appreciate it. We're going to take a quick commercial break here. We'll come back. Commodities in focus. Manisha, who joins us on the other side.
Welcome back. So equities cannot make up their mind. Let's figure out what's happening in commodities. We have Manisha in the studio now. Earlier we were talking about the fall in oil prices with this ceasefire agreement. Manisha, is it still oil or are you looking at something else now?
Well, I'm looking at the crude oil prices because, after that 5% gain in the previous week, you thought that perhaps the crude prices will see some stability right now. But no, that is not the case. Monday was 3% down. Yesterday was another percentage point of a decline. And today as well, we're trading very flat into the markets. So we are trading on the lower side of the range when it comes to the crude oil prices. 68 just about holding for WTI, and from a high of almost $75.50 for the Brent prices, we are holding around 72 onto that one as well. Well, the biggest view comes in from Israel and Hezbollah ceasefire. That accord begins from today. There have been statements from various levels, and Biden also has done a press conference on this one. So we have seen that impact come in for the prices there. Apart from that, the second thing really is about the OPEC, which may further delay planned output hike due from 1st of Jan. If they do that, this is going to be a third straight time that OPEC and allies cannot make up their mind, and they are postponing hike in output. So that also continues to weigh onto the markets. Even with what they're doing right now, if you look at the world market, it has 8 million barrels per day of a spare capacity. I mean, that's as bearish as it gets for the prices going forward. Now, for 2025, and this report is coming from Bank of America, it says that there is no case really for the crude oil prices going higher because the non-OPEC supply is expected to rise by 1.4 million barrels per day in the next year. They also expect that the OPEC and allies will perhaps reinstate 2.2 million barrels. That would come in from that. And then that would mean a surplus of 800,000 barrels per day in 2025. Add to that the fact that the new U.S. president, when he takes chair in the month of January in 2025, could be coming out with various views and steps when it comes to crude oil. One, the export permits for the new LNG projects is something that could come in. Apart from that, increasing oil drilling off U.S. coast and on federal lands is another thing that could be allowed. And the third thing is new funding for replenishing the SPR. These three things is what the markets believe that Trump will do in the first week of January itself as he takes over. And this is also going to be bearish for prices. In the meanwhile, while we are looking at 25% tariff from U.S. on Mexico and Canada, for Canada, it would mean a big number breaker there because 4 million barrels per day of an import from Canada of crude is what U.S. does. How is that going to be impacted is something that the street will look at. The second thing is the U.S. inventories, which was also declined by 5 million barrels per day in the previous week. So these couple of factors are kind of supporting the prices, but not as much. So when it comes to 2025, the Bank of America predicts that for next year, you could be looking at Brent averaging at 65 and WTI at 61. So much lower than what we've seen in the prices in this year. So further bearishness could continue.
Okay, well, we'll not complain if we see 60 to 65 on oil prices. Manisha, thank you so much for that. Well, let's quickly take a break. We'll come back with our special segment, Indianomics, on the other side. Lata will be catching up with Upasna Chatra, Chief India Economist at Morgan Stanley, to discuss the Indian economy outlook for 2025.
Welcome back. We are continuing with our Indianomics series on Indian economy in 2025. And joining me today is yet another star economist, Upasana Chachra, Chief India Economist at Morgan Stanley. Upasana, good morning. Thank you very much indeed for joining us. Well, first up, your growth forecast for next year, that is FY26, not calendar 25, but FY26, is 6.5%. Does this bake in the likely tremors we may face if there are tariff hikes in the US? How much of it is baked in? Or do you see downsides if there is an onslaught of tariffs?
Hi, Lata. Good morning and thank you for having me. So yes, our forecast for fiscal 26 at 6.5% assumes that there will be some increase in tariffs by the incoming US administration, but those would be still country specific. So our global team, both on the econ and the policy side, the assumptions that we've used in our year-ahead outlook is that there will be an increase in tariffs for China and also bilaterally for some other major countries such as Mexico or the EU. We are not assuming specific tariff hikes for India in these numbers, and also not assuming that there is a case for or an implementation of the universal tariffs as have been discussed in the past. So those are not baked in our base case. If that comes through, yes, there could be more downside to the 6.5% number.
Okay, so this is the base case. Trump can engender some downside surprises if it happens. Fine. Let me also come to the currency. And maybe I'm making an unfair question because this should beat your currency strategist. But I was a little intrigued that your currency forecast numbers don't go above 85. It is 84 for the current year average, 85 for FY26, and then it goes down. Actually, the rupee appreciates to 81 in FY27. Can you explain? Because there is a school like Goldman Sachs tells us that they expect 85.7 also in 2025.
Yes, these views are made by a currency and FX strategy team, and they do include a fair bit of what they think about how the US dollar would move. So in the near term, there would be US dollar strength, but yes, you probably will not see that too much in the rupee dollar moves or the forecast that we have in our numbers. Primarily with the view that we do think, and as a both on the econ and the strategy team, that there will be a case for the rupee to get defended and the volatility to be lower. So our view is that given that the fundamentals still remain pretty okay for the rupee and the FX reserves, and generally the trend that we've seen in the past of RBI wanting to intervene to reduce volatility, we do think that rupee will be therefore more range bound rather than depreciate at a faster pace. So that is what calls for our view in the near term.
Okay. Well, any FPI will give an arm and a leg if it's only going to be 85. But right now we are already sitting at 84.5. And there is a fear that it can, go to 85.5 also. Now let me come to the growth forecasts. Even for the current year, you are expecting the growth to be 6.7%, which means you're not buying the RBI forecast for the second half. They are sitting at something like 7.3, 7.4 for the second half. You don't think that's happening?
No, so our numbers were earlier 7%, Lata. We reduced them to 6.7 in this round of year-ahead outlook. But most of the cuts are concentrated in the September quarter. So, that is the key debate right now. September quarter growth and high-frequency data have been showing sort of a broad-based deceleration. So we do think that September would be weak. Our numbers are going to be weaker than the 6.7 for September. We are at about 6.3, probably where consensus is also right now. For second half, we do expect a rebound, but probably not where RBI is looking at. This is what they've published as yet. So our view is that you see growth picking up in second half, but probably settling more in that 6.7, 6.8 range rather than higher than that.
Okay. Let me now come to your inflation forecasts. Your inflation forecasts are pretty benign, but for the current year, you're still expecting 4.9. That's a big jump from Reserve Bank's 4. No, Reserve Bank's 4.5 is going to get revised because obviously they were not prepared for the 6% plus in the month of October. But 4.9 would mean that inflation really is not falling off.
Yes, so I do think that the near-term hump in inflation that, RBI has also highlighted, we were all expecting, but I think one is that the level is higher than what we were expecting by probably 40-50 basis points odd for both September and October. And then the deceleration as it sets in will therefore just take a little bit longer, given that you've seen us somewhat of an upside surprise. And it's more mathematical than anything that you will then see numbers being higher. So when I look at monthly data points, you're probably looking at November print, which would still be close to, say, 5.5. It will start moderating from December because of the seasonality and the winter month impact on vegetable prices, etc. But as of now, at least what we think the numbers for December, Jan could still be around the 4.8 to 5-ish levels, or probably around 4.8 rather than meaningfully lower. So I think it's a lot to do with food inflation and food inflation volatility than anything else. I think, headline X vegetables or core will still be well behaved, but headline per se, due to the impact of food in the near term, will also probably remain a little elevated than what we were thinking probably 2 months back.
Okay. At one point in time, if I remember right, Chetan was saying that he's expecting practically no rate cuts. But now you all are penciling in some rate cuts next year.
Yes, that's right. We did have a view of no rate cuts for pretty much all through this year. We have added rate cuts for next year. So as of now, we expect the first rate cut in April. We do think, by then there will be more evidence of a moderation setting in inflation. December and Feb meetings, probably with the trailing inflation numbers, will be very hard. And that's why we think the first opportunity would rather be April than before that. Just given how inflation numbers are going to be in terms of headline.
Okay. Let me come back to the growth question. Again, I'm going back to Goldman Sachs because that was the first of our series on India at 2025. The fear about growth rises on several counts next year. The fiscal deficit is going to be lower. I think even you are forecasting it lower. Plus, CapEx even this year may not reach the target. CapEx will be even less. It's not as if private CapEx has picked up, gangbusters. And on top of this, you could have a global slowdown, a Chinese dumping. So what makes you confident about next year's growth? What are the positives for next year?
See, I think structurally, the story for India delivering around 6.5% growth is still something which is doable, given where probably macro balance sheet and corporate and financial sector balance sheets are. Yes, there will be fiscal consolidation, but it's unlikely to be a lot led by, expenditure compression. CapEx numbers we've already seen moderate. If we were to assume that second half picks up, will still be lower than last year. And probably seeing, yes, but from going forward, probably you'll see CapEx numbers in terms of growth rate remaining where they are. You would see more shift in revenue expenditure in our view that would lead to the fiscal consolidation alongside pickup in revenues. And therefore the fiscal drag on growth should be lower from the fiscal consolidation bit. You will probably be seeing easing in the next year, and that should help from just the impact of monetary policy on growth, and therefore growth settling to around 6.5. I wouldn't say that growth is on an accelerating and upside trend, but more like a settling on the 6.5% normalized trend, which should be doable given where the structural parameters are for the economy.
Okay, it's almost as if it is India's natural rate of growth. Okay, very quickly then, if you can tell me what will be the upside surprise and what can be the downside surprises we should be prepared for.
On the upside, I think the key will be, as you mentioned already, on the private capex side. We are seeing some green shoots, but yes, it's not at an exuberant level. So probably external demand can come back as a bigger supporter to this overall end demand, and that can help improve the private capex cycle, which then I think leads India to a higher growth path or a growth trajectory on a more sustainable basis. On the downside, again, most of the risks would emanate from the external factors. I think at the moment, what type of trade, tariffs, immigration policies we see from the incoming US administration will be important. Again, that may still impact more of the second half of the next year in our view, because by the time it's implemented and it flows through, in terms of real economy variables, there will be some lag. But of course, markets and sentiments will start reacting much before that. But from a real economy perspective, probably second half would have more risks associated with what policies we see in the first quarter next year from US.
Oh, yes, that is the unknown, isn't it? Upasana Chachra, thank you very much indeed for joining us. So that's the key takeaway, that India will settle to its natural rate of growth of 6.5. Now, that can be a disappointment. It's not 7, which we would like it to be. But Morgan Stanley is still a little more positive than Goldman Sachs, who see it actually at 6.3. Let's see how things pan out. Thanks much for watching this special edition. After a break, Chartbusters. Thanks. Hello and welcome to Indianomics. Today we start a special series on the year ahead, Indian economy in 2025. With the recent state election wins, India's central government will be much stronger and capable of longer-term policies. The US also will have a strong government, but maybe more mercantilist. That is, enrich yourself through protections. In which case, how will 2025 pan out for India? We kickstart the series with Shantanu Sengupta of Goldman Sachs. Shantanu, thank you very much. First up, your growth forecast for this year is just 6.4, one of the lowest on the street, which means you don't think that the second half will be a pickup. Will it be slower than the first half? Thanks much, Shantanu. After the break, sorry, I'll say that again. Well, thanks very much, Shantanu, for your analysis of 2025. After this break, we are going to speak to Morgan Stanley's India specialist, Upasana Chachra, about how she sees Indian economy in 2025. Can I just take the thank you? The lead-in is fine. I'll just take the thank you for Upasana. Can I start? Okay, so 6.5, the natural rate of growth for India, not 7. Thank you very much, Upasana, but that is still better than the Goldman Sachs forecast of 6.3. With that, we wind up on Indianomics. Thanks so much for watching. Okay.